What should you do if you want to save more money, especially for your immediate savings and your future savings? I have 8 different ideas for you to help you save more money. First and foremost is foundational savings. Whenever we meet with a client for the first time, we ask them, how much do you have in your emergency savings account? Emergency savings is that bridge that gets us over all the struggles in life and gives us a strong plan B. If you are self-employed or single or head of household, those savings rates will be different. So let me give you a couple tips. If you and a spouse both work in a dual income family, well, 3 months worth of expenses is probably good enough. If you're single or if you're the sole breadwinner for a family, well, maybe you need to have as much as 6 months worth of emergency savings on hand. And they're not doing fun things. This is boring savings that's just sitting in the bank, but it's never at risk. What if you're a high earner or maybe you own a business? Well, you ought to have at least 18 months worth of emergency savings on hand. Idea number 2 is health savings. The government gives us lots of incentives to save money for healthcare. The first and one of the more popular ones is a flexible spending account. This usually occurs for employees inside of an employer-sponsored plan. An employer-sponsored flexible savings account allows you to put $2,750 into a flexible spending account every single year, and you can use it for an assortment of healthcare needs, including dental visits, including medical deductibles. You can use it for dependent care, either children or maybe dependent parent care. Lots of different ways to use it, but the important thing is that you use that money in the year the contribution is made. It's a use it or lose it account. The second and more unpopular solution combines with a high deductible healthcare plan. It's called a health savings account. Health savings accounts are probably one of the greatest government incentivized saving tools out there. A health savings account allows you as a single to put $350 into your account, or as a head of a family, $7,100 in. If you're over 50 years old, you can get another $1,000 in. That money goes into the account. It can accumulate, meaning it doesn't have to be used that year. And when you put the money in, it's tax deductible. When you pull the money out for qualified medical expenses, it comes out tax free. So in tax deductible, out for qualified expenses, tax free. And it accumulates year after year. Great savings tool. The third solution for saving more money is the more obvious. This is an employee-sponsored retirement plan. Commonly 401ks, but they come in derivatives of that, like a 401a or 403b. These type of retirement plans allow you as part of employment to contribute more money, tax deferred, for your retirement. A 401k allows you to put in as much as $19,500. If you're over 50 years old, you could actually get $26,000 into that account. Another great solution that's more contemporary to retirement plans is a 401k with a Roth option inside it. That allows you to put the same $19,500, or again, over 50 years old, $26,000, but you pay it after taxes. Therefore, it grows tax-free. There's a huge benefit in that. And if your employer does allow you a Roth option inside your 401k, well, let's talk about what's called a mega backdoor Roth conversion. If you'd like to learn more about mega backdoor Roth conversions, click on the link or the button below, and let's talk about that one-on-one, because every scenario is a little different, every solution is different, and we come to you with proprietary software to help you determine what the taxable implications of doing such a thing is, and what are some of the gotchas that we want you to stay away from. A fourth option, also inside of retirement plans, is an employee-sponsored benefit plan. A little bit different than a 401k, but sometimes they're close cousins. A 401k coupled with one of these makes it all the more beneficial. For example, a profit sharing plan. That individual with a 401k and a profit sharing plan now can get more than the $19,500. They can actually get $57,000 into a retirement plan, helping you save even more money. If you're over 50 years old, you can get $63,000 in there. There's other retirement sponsored plans in there, employee sponsored stock options, employee-sponsored pension plans, all these fall in that same map of using an employer's benefits to help you save more money. Would you like to know how yours works? And maybe yours is just a little bit different. Well, click on the link or the button below, and we will walk you through how your specific plan works and make projections using some of our proprietary software to help you determine how much you will really have in retirement. The fifth option, what if you're not an employee, but you're a business owner? What's out there that you can do specifically? Business owners have lots of tax savings opportunities. They have lots of money saving opportunities. Let me give you just one example. What if you're a business owner and you have children? What a great time for you to pay those children at their tax rate, a lower tax rate, and avoid FICA taxes. You really want to have that child be over the age of 11 years old, and you want to have them under certain age limits. And even better, if you could couple that with a Roth IRA for the child, that would mean that you could pay the child at a lower tax bracket and roll those funds into a Roth IRA. Those Roth IRA funds can be used for a whole assortment of different benefits for that child, including healthcare, first-time home, higher education, and of course, retirement. If you'd like to know more about how this concept works, click on the link or the button below, and we will spend a little bit of time with you walking you through that. The sixth item is helping future generations. Maybe you have enough and you want to provide for your posterity. You want to do some more far-reaching estate planning. There's lots of ideas out there to help you save money for the next generation and the generation after that. The first that comes to mind is a 529 plan. Those can either be done through the state that you're in, or you can do them privately through a brokerage house. A 529 will allow you to put as much as $15,000 per year. That's dictated by the gift tax laws. Or you could do a lump sum of $75,000 and take credit for 5 years worth of contributions all in 1 year. And that money can grow tax-free as long as it's used for qualified education expenses. Other accounts that might help you save for future generations are UGMA accounts, UTMA accounts, underage guardian managed accounts. These accounts allow you to dictate the savings tools until the beneficiary comes of age. And that might be 18, that might be 21 years old. And the final, much more complex scenario would be a dynasty trust. Any of these scenarios, let us walk you through the details of them because they're kind of complicated. Click on the link or the button below, and we'll schedule a little time to walk you through how these might work. Idea number 7, tax-deferred savings. Tax-deferred savings would take a non-qualified or funds that have already had taxes paid on them and protect you from capital gains. That's a growing issue as capital gains rates look like, not guaranteed, but they look like they're about to go up. So that might be using a tool like an annuity or a life insurance plan. Both provide tax deferred opportunities. Both have different tax implications when you pull the money out. Both have things that you want to pay attention to and be aware of. We'd love to walk you through how those will work. Click on the link and button below and we'll spend 30 minutes walking you through how utilizing an annuity or a life insurance policy to help you grow your personal savings and avoid some of the gotchas would benefit you. Here's idea number 8. It's charity. Charity is a big deal right now. Lots of people struggling, and lots of you are very generous and kind-hearted. Charity is also a great tax deduction. If you're charitably inclined, but you still want to take your standard deduction, which is much higher than it used to be, well, you want to use a donor advised fund. A donor advised fund allows you to group charitable donations all into 1 year so you can get that charitable deduction. And then over the course of the remaining years or the following years, you can have your advisor make donations year by year into the charities of your choice. Of course, the charities need to be 501c3s, but they do allow you some latitude of contribution and control with the assets moved outside of your estate. Talk to us about a donor advised fund by clicking on the link or the button below. We'd be happy to walk you through how that might work. And the final one is life insurance. Using cash value life insurance is a fantastic way to give a large lump sum to a charity. Again, using annuities, using insurance, there's lots of gotchas in that. We want to make sure that we keep your foot out of the bear trap and help you along this method, making sure that you give the biggest amount at the least expense with very few costs to you. Click on the link or the button below to learn more. In addition to all this, we created a checklist of many more ideas for you. We've linked it to the show notes today. You can click on that link, download it. We're here to answer questions. Thanks so much and good luck in saving.